So, good evening, everybody. My name is Anna Obижаева, and on behalf of the NES Department of Finance, I would like to welcome you to our first roundtable in the series of events on public policy events in finance that we're going to organize. So this time, actually, there are many events held by different, organized by different institutions, universities, government agencies about financial crisis, because it's exactly the 10th year anniversary of the global financial crisis. So it's a very good occasion to talk about what has happened 10 years ago, what has happened since then, to discuss all of the regulations implemented, to think about what has been done, what measures we still have to take. Is our world a better place now than it used to be 10 years ago? Or we're missing some critical elements that we still need to think about? So today's event, it will be the first event in the series of events, but today's event will be on bank regulation, which is very important. We have, our goal, the goal of these roundtables is to engage NES community, professors, students, graduates into thinking about and discussing public policy questions. Questions that are important for our country, questions that are important for the rest of the world. So this is our goal. And today we're very privileged to have exceptionally good speakers, exceptionally good guests, very knowledgeable guests. So we have Alexei Lobanov, who is the Director of Banking Regulation at the Bank of Russia. He knows a lot about regulation of banks in Russia, and I have asked him to share some of his ideas and thoughts on this topic tonight. Though I have to say and emphasize that whatever he'll be saying today will represent only his own views and not the views of the central bank, the Bank of Russia. So NES would like to provide some very neutral platform for everybody to come here and to discuss important ideas. So then we also have Alexei Bogatov, who is the Director of the Integrated Risk-Management Department at Sberbank, the largest bank in Russia. So he will talk about these issues from the perspective of Russian industry or Russian banks. Unfortunately, Jangirov couldn't come because he had to travel abroad urgently. But I would ask Alexei to make up for two representatives of Sberbank tonight. And then finally, we are very privileged to have Mартин Хеллвиг. Martin is one of the most respected economists of our time. He's a theorist who did a lot of influential work in the area in different fields, in information economics, in contract theory, in banking, in my own field of market microstructure. He is also probably one of the best people to discuss current economic affairs in Europe. Because being an academic, being a professor, he has been very actively involved into public service, into policy making, and he has served on many different advisory committees and supervisory boards, sharing his knowledge and deep understanding of how markets work with policymakers, with regulators in Europe, in Germany. So today I have asked him to share a bit his views, to provide some European context on the issues that we're going to discuss, and also, share maybe comment on whatever he will heard tonight about how Russian banking system works. So, with this introduction, we have, as I said, we have many good guests, and we have a lot of important questions for them. So the plan for today is the following. We will start, I have asked our speakers to start with some opening remarks. First, to talk about their general views on bank regulation over the last 10 years, how it has evolved. And I have asked also them to talk a little bit about their own personal involvement into these issues, in what capacity they had to deal with the bank regulation. So afterwards, we will talk about several topics, several important issues important for the Russian banking system. We are very welcome to get questions also from the audience, but let's see how it goes, and probably we'll wait a bit till the end of our discussion to collect questions. Okay, so let's start and see how it goes. Please, whoever would like to be the first. Maybe Alexei Lobanov.
Hello, good evening, ladies and gentlemen. I'm very delighted to be here in these walls again after, I think, more than 10 years, and it's my first visit to this new building of the new economic school. I attended several events that were held in the previous premises on the Himovsky Prospect, just across the institution where I had my postgraduate study. Just a few words about myself. I started my professional track in the 90s in one of the very first Russian investment banks, and have seen the blossom and the decline of the Russian stock market in the late 90s, and I also witnessed the Russian default in 1998. So we just celebrated, so to speak, 20 years since this memorable event. And I also spent more than 10 years in financial risk management, doing research, consulting, and training, mostly for people from financial industry, but also for large corporates, including Gazprom, Norilsk Nickel, and other companies that are exposed to a variety of risks, including financial risks. And I also had some experience in research and studying banking regulation, risk regulation, and economic history. When I graduated from the Russian Academy of Science, I embarked on a number of PhD programs abroad and was offered admissions from some of the leading schools, but didn't go there for some reasons, for which I have no regret, because practice, especially current regulation, is by far more interesting than the most advanced theory I have ever heard of or read about. I will try to give you some flavor of what we are doing later on as we move on in this discussion. And besides my current work as head of bank risk regulation, I've been involved in designing the international regulatory framework as a member of the Basel Committee Working Group on Market Risks, formerly known as Trading Book Group. Some of you may have heard this term as FRTB, a fundamental review of the trading book, the new regulatory standard for capital adequacy for market risk. So my 2 pennies are also in this standard that will soon come into force, soon I mean in a few years. So this was just a brief introduction about myself, and speaking about the topic of today's roundtable, my personal feeling is that we have passed a long way since the global financial crisis of 2008. The markets, the banking sector, and the regulators have changed dramatically. We have witnessed at least 2 stages, 2 waves of international standards and recommendations of financial regulation. So the first stage is known as Basel III, and the next one is often dubbed as Basel 3.5 or Basel IV. And this wave is forthcoming, and I hope it will not flood all of us to the point of unmanageability, so to say. My feeling is that some lessons learned from the crisis have been closely studied both by the industry and by the regulators, partially implemented in the new global framework of financial stability, because this not only includes regulation, standards, rules of conduct, recommendations of all kinds, but also some generally accepted views, concepts, and ideas. What banking business, sound banking should look like, what type of behavior is expected from bankers, and ultimately what the future of the global financial system is. And it will be very interesting to also learn your views if you ask questions and take an active part in today's roundtable. Because what we see can be described as a sort of game between the regulators that would like to impose even stricter rules on banks, and banks willing to dodge these rules and to preserve as much return on equity and assets as possible. And if you look at this game, you will probably see less of an academic science, but a sort of some kind of sport, because it's always a race. Banks invent new schemes, new creative ideas how to evade new regulations, and regulators will have to catch up with them and draft rules that become even more complex, less tractable, less manageable, and ultimately, it's my personal view, of course, but many of my colleagues from the working group share this view that the new regulatory standards have probably missed the optimal trade-off between simplicity, sensitivity to risk, and transparency. They are too complex for banks to implement and costly at the same time, and too complex for us as supervisors to enforce. Yes, we have reached a point where the new standards, for example, of capital regulations, they will be more sensitive to risk, but at what price? I think the price sometimes is higher than the result that we have achieved. So these are just a few words as an introduction. I may sound provocative at some point in time, because we will discuss topics that are really hot, both for us as Russian bank system regulators, but also for the rest of the world, because sometimes we face the same problem, even if we describe them with different terms. Thank you very much, and probably.
Good evening. My name is Alexei. I represent the perfect battleground for both gentlemen here. Before I came back to Russia in December last year, I spent 3 years being the Chief Risk Officer for Sberbank Europe in Vienna. And I have observed the ECB in the making throughout this time. So I have seen and I have been involved in the implementation of the regulations as imposed by the newly created supervisor, which is ECB. And now we are actually not trying to run away from the regulation as imposed by the Russian Central Bank, but now we are in the active discussion as to the implementation here in Russia. Thank you.
Thank you very much for inviting me here. My background, as Anna said initially, is originally as a theorist. And by theorist, I mean really abstract, formal stuff. At some point in the early 90s, I was asked to work on why do we regulate banks and how should we regulate them? And I thought about it and looked at what had happened, and I discovered, well, most of the real problems have not to do with the cashier stealing money or so, but with macro shocks. So why are banks so exposed to macro shocks? And I wrote a paper on that, saying it's not efficient for them to do so. By macro shocks, I mean the business cycle, large swings in interest rates, exchange rates, and things like that. And at some point, I talked with a person from Swiss Bank Corporation. I was located in Basel then, and this person asked me, what are you working on? The rare banker who asks such questions from an academic. I explained it. Oh, but we are not exposed to interest rate risk. Now, I knew that at that very moment they were suffering because short rates were larger than long rates and interest rate risk had fallen out badly. I also knew that many of the crises around that time had to do with huge interest rates, and 10 years before, the American S&Ls were bust because of high interest rates. And then I asked myself, what's happening? Why is this guy saying, well, we're engaging in A&L management. We use the money market to do maturity matching. Well, almost. Why is it, I asked myself, that this person perceives what they are doing as being very different from what I know they're doing? And the answer was, because of systemic interdependence, they don't really know what they're doing. And I think that's a key issue about systemic risk. To give an example, in 1997, when the Asian crisis broke, well, Thai entrepreneurs who had been given loans in dollars found that after the devaluation of the baht, they could no longer pay their debt. And the Thai banks, who'd been very clever and thought that they could hedge, found that an exchange rate risk had come back in the form of counterparty risk. Now, why had the Thai banks lent in dollars? Because they had borrowed in dollars from international banks. Why had the international banks insisted on lending in dollars? Because they didn't want to have any exchange rate risk. But the exchange rate risks that they had gotten rid of their books, that they knew they were not carrying, was just transformed into counterparty credit risk. So in 2007, 2008, I thought that much of this looked familiar. The impact losses of the subprime crisis in the US actually were not larger than what the impact losses in the S&L crisis as of 1990 were guessed to be, or the impact losses in the Japanese crisis. The difference was contagion and systemic interdependence. So I worked on that. Now to come to, and as a consequence of this work was also recruited into the Advisory Scientific Committee of the European Systemic Risk Board and other institutions. Now, if you ask me, where are we now? I've just written a paper for a German review. If Lehman Brothers happened today, all the mechanisms that caused systemic risk in September 2008 would still be in place. The first mechanism was a money market fund that had given money to Lehman's broke the buck, as it was called. The value of a share went below $1, and there was a run on the money market fund and others as well, and the money market funds ran on the banks, and the money markets froze. In the European Union, we had a similar sequence. In 2011, it was aborted, fortunately, by the European Central Bank. But the dependence of money market funds, in particular dependence of European banks on US money market funding, is still there. And that mechanism, a run on the money market funds and a run by the money market funds, could go off any day. Lehman Brothers had separate establishments in London and in New York. London was for their derivatives trading. Bankruptcy meant different authorities entered in London and in New York, but they had integrated processes like integrated cash management. When the authorities entered in London, there was no cash. That had gone to New York at the previous close of business. They couldn't even maintain systemically important operations in London. We still have multiple point of entry resolution in each country where there is an independent judicial unit. The authorities of that country enter. I could go on, but I don't want to preempt your different questions. You were mentioning Basel III, Basel IV. My label would be Basel 2.01, because some of the major flaws in the conceptualization of Basel are still there. The main problem about the rescue operations of 2008 and 2009 is that they were successful. So successful that the industry did not lose credibility as it lost in the 4 years between 1929 and 33. And the negotiation about Basel III was already very much influenced by the Institute of International Finance, which was a representation of the big international banks that saw to it that there wouldn't be too much by way of tightening of regulation. So I stop there.
Okay, thank you very much for this opening remarks, and we will come to discussion of Basel 2 or 4, how you call it, a bit later. Let me propose to talk about the following topic that is important for Russian banking system. It's this very active cleaning up of Russian banking system recently. We know that since about 2013, the Bank of Russia is very actively involved into cleaning banking system. So the Russian banking system was sort of had this unique feature that it had many banks with very problematic assets on the balance sheets, with very questionable business models on the eve of 2008. And most of these problems came from 1990s, from the time when, after the collapse of Soviet Union, the modern Russian banking system was born. So let me suggest to talk about what you think about these procedures. On the chart, I have the number. Essentially, this figure shows the number of banks in the Russian banking system from 2001 to 2016 in dark blue columns. That's the number of banks. So it essentially went from about 1,300 in the beginning of 2000s to about 1,000 in 2012, and now there are about 560 banks or credit organizations because many licenses have been revoked and many banks have been closed. So let's maybe talk a little bit about this topic. Maybe I'll ask Alexei to talk about what I think about this. And
thank you, and I also would like to hear your views about this picture. If you could expand it into the 90s, we could see the total number of banks, I think, close to 2,500 or something like this. So the regional population of Russian banks was like a universe. It included thousands of credit institutions, most of which did not earn money on lending. What we all should remember is that before 1998, lending was not the principal activity of Russian banks. They all earned economic profits from financial markets, mostly from the market for government debt, which was essentially a form of a hidden subsidy from the government. And it was a rich subsidy. A lot of market participants enjoyed it. We all remember a concept of a sovereign debt with zero or close to zero risk and yields up to 200% per annum. This all ended in August 1998. Quite a few large Russian banks collapsed, and we all remember the names of these institutions that did not survive that crisis. But we do know how many banking crises were there in Russia since the onset of our banking system. So August 1998 was not the first one. The first one observed and recorded in the recent economic history was the liquidity crisis of 1995 that led to the demise of at least a handful of medium-sized and larger banks. So this was the first bell for the banking system. So the second one was in 1998. The banks that survived the crisis by chance or by means of savvy policies, they embarked on lending. Mostly this was corporate lending. Later they moved on to retail lending. And so in the noughts and in this decade, a huge chunk of banks' profits came from lending, and much smaller part of their earnings came from financial markets, from trading, and from investing into interest rate bearing assets. I consider this process as a natural evolution, as the maturing of the banking system, a process that took at least 100, 150 years in the West, and it took us only 25 years in this country. It's a steady decline of the value, of the intrinsic value of a bank charter, of a bank license. A bank license could actually earn millions in the 90s, just because the bank could be used for any sort of financial activity, from related party lending, trading on financial markets, clever schemes related to money laundering and things like that. But now the the banking market has become more mature and closer to economic fundamentals. So the intrinsic fair value of bank charter has declined. So if we could somehow measure it, I'm sure it will be closely correlated with this chart you see here. A lot of banks were founded in the 90s for specific purposes pursued by their owners. This could be raising money for business that didn't have anything to do with banking. For example, there was a fancy trend of investing depositors' money into commercial real estate, into construction industry. And this was the principal business of the bank's owners. The bank was used solely for raising money. Essentially, it was not a bank. It was something like a bank counter that took deposits that were channeled into activities not related to banking, but that represented the true interests of the bank owners. A lot of banks were part of the so-called financial industry groups or conglomerates, and they just used for serving cash flows that circulated in these conglomerates something that was called captive banks. I hope you know the concept of a captive insurance company, and a captive bank is very much the same. It's a pocket bank that was needed to fund the principal economic needs of these financial industrial groups. A lot of bank licenses were granted to people that didn't have a clear idea what they would do with this license. They hoped for better times. They essentially viewed this license as an asset to invest in. And they waited for better times to sell it. Some succeeded and they did sell these assets. Some, unfortunately, they didn't, and had to either ask the central bank to revoke the license, or engage in some shady economic activities like money laundering, just to survive on the market that grew more and more competitive. I personally have witnessed the, I think, past 6 years of this chart, which resulted in a more than a 1.5 times decrease in the number of the banking population. But at the same time, is it possible to have a look at my presentation on slide 28? Just like to show another chart to illustrate. Thank you very much. This one. I will try to magnify it in just a second. So, because what I would like to show you is only this part. Can you see? So the blue line is the volume of banks' assets. So the reduction of the number of banks, so the decrease of the population of banks, did not lead to a decline in the volume of banks' assets. And I think this is a good illustration of the true side of what's going on in the banking sector. Yes, we're losing more and more smaller banks, mostly smaller banks, but not always smaller banks. Just recall the banks that went to a resolution by formerly by the deposit insurance agents and currently by the Bank of Russia. There were large banks, large credit institutions that essentially went bust and were taken over by the central bank. What you see here is essentially the condensed evolution of the banking market in Russia. I believe that the number of banks will gradually decline over time. I don't know what the target, the optimal number of banks is just fit for this country, and I think no one knows.
Let me maybe interrupt a bit and ask Alexei, the second Alexei, about what he thinks about this. Some of the banks that were closed were quite small, but some, like Открытие, for example, were quite significant. So Открытие would be probably in top 5, 7 of Russian banks. And when it got into this resolution procedure, many people thought that it may create some distress in the market, but it seems that it has gone on quite smoothly. So what do you think about how effective the mechanisms of resolution of these large banks? So we still need to improve a lot of them.
Just one final remark to this chart. What I'm really worried about is not the decline of the total population and not the number of licenses revoked, but the absence of new entrants to the banking system. And from a school course in biology, we all know that the population will be stable if the number of deaths is outnumbered by the number of births. We don't see any newcomers to the banking sector, which for me is an indicator of its fundamental unattractiveness for investors. Although large banks are still present and can work and earn economic profits in this market, but there are no new entrants. You may see this from the statistics of the central bank. So this is one of the troubling signs.
So first of all, my views do not represent the views of the Sberbank. I think when we talk about license withdrawals, as we have seen that in Russia, I have been always asking myself, what is the business model behind those banks? We have had, 1,000 of banks before. What was the business model behind those banks? Sberbank is pretty clear, it's the economy of scale. There are some banks which go into the niches and they have their own customer segments. But such a large number of banks makes you question the whole concept. On the other hand, when you think about banking, it's rather complex, and it also requires an incredible corporate governance. It requires a high level of maturity of people behind that, because that's a not straightforward business, and you need to have a proper education to run the bank. And if the licenses were given out just to serve the captive interests, over time that can become a burden. Because from the other perspective, when you think of it, how can you actually hand back the license? So once you got the license, how do you hand back the license? If you run a wind down of the bank, that can be very cumbersome and very expensive. And there was no procedure per se to wind down the bank. On the other hand, I think Central Bank of Russia knows its trade, and the license revocations, I think they were to a large extent justified, because the revocation of a license is a big event. What should you do as a bank to get your license withdrawn? You need to really cross the red line. When you talk about the bigger banks, I think there are two components to that. One component is that has it actually shaking the financial markets, in the sense that was the revocation of the licenses from the bigger institutions a threat to the general financial market infrastructure? At a certain point in time, it probably was. I'm sure that central bank have had its own reasons. However, what raises the questions now is that what those banks would do. If you think from a perspective of the capital that they have received and the potential market situation from the competition perspective, one of the questions that we will probably discuss here is the market competition, but those banks have received the capital injection in a sense free of charge from the respective agencies in the central bank. And now what would be their next competitive action in the coming years? That very much changes the competitive landscape also for us as a systemic institution on the market.
Okay, thank you. Let me ask now, Martin. So it seems that Russian regulators are very actively involved into cleaning banking system in Russia, but at the same time, it seems that in Europe, regulators are much less active in this, because a lot of European banks have balance sheets sort of clogged with bad assets. What do you think about it?
Okay.
Okay, first of all, let me congratulate you on moving ahead on this subject. I am a bit concerned about the observation that on corporate loans, share of bad loans is rising and provisions relative to share of bad loans is falling. So I think there may be some work ahead. Now, as a matter of principle, I think it's very important to clean up banks' balance sheets. Have banks leave the market, and of course all the rescue operations of 2008 erected artificial barriers to exit. We have some additional artificial barriers to exit anyway. Now, there is always a lot of resistance against that. Why? Well, if you've promoted your financial sector as a mode of industrial policy, think of Cyprus, you don't want to shrink it again. If you're a supervisor, you don't want to recognize that the guys you supervise have done bad things and you didn't stop them from doing so. If you're a central banker, you may feel that you need those banks to lend and promote the macroeconomy. Same thing if you're a finance minister. So there is a lot of resistance, which is one reason why this topic has not been picked up. The non-performing loans, interestingly, are currently being reduced, at least to some extent, without going through resolution. Now, a key issue about resolution is in the European Union, we don't have a workable resolution regime. Why? I already mentioned the cross-border issues. Now, for the euro area, within the euro area, that might be handled by the single resolution board. But then there is another issue, liquidity. While you're going on with the resolution procedure, you need some funding. And even after you send these guys into being wound down, you need funding for the winding down. In the case of the S&L, as I mentioned before, that as of 1990, the losses have been estimated at 600 billion. In the end, it was about 150 billion. The reason was that the Federal Deposit Insurance Corporation had funding from the US Treasury that, liquidity provision from the US Treasury that allowed it to just wind down loans slowly. With industrial assets, machines, it doesn't make much sense to wait. Either you can sell them or you cannot sell them, and that's a 0-1 thing which you can discover very quickly. With an entire firm, like selling a bank to another bank, same thing. With loans, you need to think in terms of 10, 20 years. Otherwise, if you sell them at a discount to a hedge fund, you can have a 90% write-down. That does wonders for the resolution and wonders for the hedge fund, but it's not really what you want. Now, there is absolutely no provision in European law for funding, both during the 6 months that the authority takes to decide what to do with the stuff and the 15 years afterwards. Why not? Well, the 15 years afterwards are under national law, and national law tends to be standard insolvency law, meaning you've got to get rid of the stuff quickly. The 6 months are European law, but in the case of Deutsche Bank or BNP Paribas, you would be talking about a quadruple-digit billion number. Can you imagine a German politician accepting a European fund to provide guarantees for a quadruple-digit billion number? I mean, I've talked to people in the ministry, told them if you don't provide for liquidity, you can forget about the whole thing. They couldn't do it. The suggestion was that the ECB might do it. the ECB fund a bank that's in dubious solvency? Unspeakable. The ECB, in fact, has decided they're not going to provide funding and resolution. So that gives you some idea of why things are as bad as they are. The sort of controversies around the euro crisis overlap with the standard resistance against winding down banks anyway.
Do you want to add something? Maybe you are looking at the picture about non-performing loans.
Well, I would add
That Martin mentioned.
Anecdote from Hungary we had. What has happened with the NPLs when Hungarian central bank got concerned about the NPLs, they have introduced a regulation which penalizes from the capital perspective the NPLs in case you have them real estate covered. And in several days there was a state agencies coming up to the banks asking the banks to sell the real estate exactly at the price which makes sense from an economic point of view for you. So that was basically a very interesting regulation which sort of promoted that you offload from your balance sheet. But on the other hand, if you don't, you have a sort of coordination between the government and the central bank, which was questionable, honestly.
One more sentence. Why do I think this stuff is important? There is a huge empirical literature in the development area which suggests that it's best to clean these things up right away. If you don't, the eventual costs, both to the budget and to the macroeconomy, can become larger. And the sort of contrast that one tends to use is Sweden and Japan in '92. Sweden took control, cleaned the stuff up, and by '95, '96, the problem was solved. The Japanese did not do so. They just procrastinated and swept everything under the rug, allowing the banks to keep non-performing loans, well, loans of zombie companies in their balance sheets in order not to be recognized as zombie banks. And there is a literature saying that this very much prevented funding of new enterprises with new projects and contributed to the fact that Japanese productivity growth in the 1990s was the second lowest in the OECD, next to only Italy.
Okay, thank you. I'm thinking that it's good that the Russian central bank and Russian government has actually capacity to deal with all of the bad assets in the Russian banking system.
Just a quick remark. I'm not in bank resolution, but this chart shows you the price of zombie banking in Russia. It's only the most recent price paid by the Bank of Russia. This does not include the total number of loans given to deposit insurance agency that formerly acted as a resolution manager and as a lender to investors willing to recover a bank. So the magnitude of funding you can see from this chart. And what Martin said, that the central bank decided to step in and take over this role from the deposit insurance agency for two reasons. In fact, there were more reasons, but two of them were really important. One is the price of the resolution. The former mechanism was based on earning income on the interest rate differential between the market interest rate and the interest rate charged by the deposit insurance agency and ultimately by the Bank of Russia from the investor. So this interest rate differential was supposed to be enough to cover the gap in the balance sheet. So the black hole, as we call it, over the course of the, say, 10, 15 or 20 years. But as the market price got lower, So the total number of funding needed to earn the same income multiplied. And it was decided that this scheme was no longer economical, and we moved to direct funding from the central bank, stepping in as an equity investor and essentially covering the black hole in the bank book upfront, recapitalizing it and acting as a temporary bank manager before it is sold or transferred to other investors. And we also provide liquidity. So you see not only injections in bank capital, but also liquidity injections as well on this chart.
So this leads me to another topic, because some of the opponents are saying that this type of actions reduce competition in the banking sector. So my next question would be, should banking sector be competitive? Should the government and regulators try to promote competition in the banking sector? Or just the opposite, to help big Russian banks to be successful? So what should be the level of competition in the banking system in Russia and in general in other countries? And to discuss this, let me show you a table of the largest Russian banks. This is a structure of Russian banking sector, with the Sberbank accounting for 30%. These are correct numbers, so approximately. So about 30%, and the next one is VTB, 15%. So what should you think about this, and what are your thoughts about this? So maybe how much of competition, Alexei, do you feel from other market participants? And maybe there are some particular sectors or segments where you feel this competition.
Well, we believe that we are in a competition, so we do not consider ourselves enjoying the leisure of being alone on the market. Also, what I would like to say is the following. If you look at the European banking landscape for the last, I think, 5 years or so, so the market champions, so those banks that show the sufficient capital adequacy and a sufficient return on equity above the equity cost, are mostly the banks from Scandinavia. And the reason why this is so is that those banks are local champions, more or less. So they also enjoy the economy of scale. In general, I think Sberbank publicly has been promoting the competition, but as I said before in the discussion of the bigger banks resolution, the question is how. So when you recapitalize and provide liquidity on a non-market condition to the bigger players, there is a questionable consequence for the market competition.
Let's do the numbers. Let's add up the market shares of the top 5 Russian banks. So 30 plus 15 plus 7 plus double 4 will yields 60%. So my number, calculated as of the 1st of September, is 59.6. Is it high or low? I don't know. But I know the numbers from some other countries. For example, in the Netherlands, top 5 banks control 89% of total bank's assets. In France, 82. In Belgium, 66. In Spain, 65. In Brazil, so one of the BRICS countries, the share of the top 5 banks on the local market is 82%. In Canada, the share of top 5 banks is well beyond 90%. And there has been no single case of a bank bankruptcy in Canada since 1920. So the system has been extremely stable. And some research indicates that the return on equity and return on assets in Canada has been sustainably higher than in the United States. So this is my comment. let's wait and see. So we're not the country with the highest concentration of banking assets and with the lowest competition, and this inspires me with somehow.
At this point, I'm actually wearing two hats because for 8 years I was at the German Monopolies Commission. First, I think it's a problem to think of competition as a policy variable. Competition is not something that you switch on or off. The United States thought that they could do so, had Regulation Q, which restrained competition between depository institutions, and lo and behold, by 1980, Regulation Q was a recipe for disaster because competition outside the banking sector had arisen and none of this was viable anymore. So, and a lot of the things that we're talking about have to do with restraints on competition which led to such effects afterwards. By the same token, I'm skeptical of any policy of champions. In the case of Germany, the Reichsbank's policy of giving preferential treatment to the large private banks was a reason why the large private banks were careless about their liquidity management and why the twin run on banks and on the currency in the summer of 1931 precipitated to such an extent that the Reichsbank no longer could provide the private banks with liquidity because it had run out of foreign exchange reserves. The point about that is a policy of national champions, where the champions assume that they will be helped in times of trouble, is a recipe for disaster. Some of those very stable systems that you mentioned are also very costly for consumers. If you go to the Netherlands, if you go to the Scandinavian countries, they have tightly knit oligopolies where both on the loan side and on the deposit side, they really reap their money. And having a nice oligopoly is not a guarantee for stability either. The UK has a nice oligopoly at the retail level, but the UK was quite strongly affected by the financial crisis in 2007, 2008. So where does this leave us? I think we should not think too much about promoting anything, either competition or monopoly. We should be aware that the banks need to earn profits. And my big worry at the moment is that with all the artificial barriers to exit that we have had, in particular in my country, we still have too much capacity, too low margins, and I'm quite worried about that, quite worried about a lack of profitability creating instability. Otherwise, I think having more competition is a good idea as a way of, well, making the bankers more alert to risk than they have been in the cozy times. A final point on detail, I'd be very much averse to making any comment on competition in the Russian banking sector on the basis of this list or this diagram. Everything depends on what the markets are and where these guys are active. If I would draw up the same list for Germany, and I've seen this list quite often, the major player, namely the savings banks, would not even appear on the list because they're legally independent units and therefore don't make it into market share statistics. One really has to look at the markets in terms of retail. They're dominant. And this may differ from market to market.
So, continue this. So, are there some sectors or segments where you feel competition from other market participants, or some sectors where you feel quite comfortable not facing much competition?
Well, I'm not representing the business side, but in general, I would say the way we see it from the structure of the balance sheet, and especially when the times are changing and how the structure of the balance sheet is changing, it is a very competitive market on all ends. Of course, we have a joy, so to say, of scale, and of course, we have a very special reputation on the market, which allows us to have a cheaper funding than most of the other market participants. But this is not to say that there is no competition.
There is some competition, I would say marginal competition from insurance and microfinancial lenders. But this competition is not really dangerous for banks, for their charters, and for the fundamental value of their licenses. In my view, the toughest challenge comes from the fintech industry. A few years ago, I made an analysis of the core bank's activities that are challenged by fintech. And my conclusion was that currently, virtually all but one bank functions can be replicated by fintech newcomers, be it corporate, SME lending, small and medium-sized enterprise lending, retail lending, payment and settlement, trading. The only exception is deposits. Deposits and liquidity insurance provided by banks as their original function. This has not yet been reproduced and replicated by fintech, and I don't know whether and when it happens, but if it happens ever, this newcomer will become essentially a bank. Probably without a bank license, but it will act as a real bank with its core activity of taking deposits and investing or lending to third parties. And I see this challenge as one of the most interesting research problems. What actually awaits the global banking sector in the future? Will it eventually liaise with fintech? Will it take over the fintech industry, or will it succumb to this challenge and be taken over by fintech? I don't know the answer, but over the course of my lifetime I will learn it.
Let me ask Martin, maybe, have you thought about fintech, and what do you think, will it somehow affect the competition in the banking sector?
I've thought about fintech and not really come to much of a conclusion about it. Some of the discussion reminds me, well, no, it doesn't remind me. In thinking about fintech, we should be aware that we have had another technological revolution in the 80s, derivatives, which has transformed the industry, initially through the initiative of new traders, but eventually it was taken over by the major organizations. So to the extent that fintech has lasting value, I would expect the same thing to happen. And I don't see any reason why one should be particularly worried right now. That being said, with at least blockchain technology I'm skeptical about the potential for growth for the simple reason that the environmental cost is enormous. I mean, energy cost and environmental cost is enormous and growing, and I don't see that technology, at least, unless it's very much changed, as really capturing a very significant part of the business, basically because there are capacity limits to how much energy can be provided.
Okay, so I would think that competition is good in banking sector if banks compete for whoever has the better risk management model. But when competition is about some charging monopolistic profits from clients, it's probably not a good competition. So talking about risk management, I think it's natural to talk about capital requirements, which is at the heart of bank regulation, modern bank regulation. So there have been lots of discussions about what should be the level of capital in the bank. Can you bring my, flip the slide so that, so this is my next slide with my next question about what should be capital requirements for banks. Essentially, this is just a very, it's mostly for students in the audience, I guess. It's a little balance sheet of a bank with the liabilities on the right-hand side, deposits, some bonds, equity, and assets on the left-hand side, with different with reserves, loans, maybe different securities potentially. So the big question in the modern bank regulation is what should be the amount of equity that bank should hold, because assets are risky and equity can be used to provide some sort of buffer against changes in the level of in price of assets. So the question is, what should be the level of equities in the bank? There have been lots and lots of discussions about what that percent should be. And let me ask maybe Alexei to talk a little bit about some Russian specifics in this way, because the Russian regulation is slightly different from regulation that exists in Europe. And then we'll ask Martin and another Alexei about what they think about this.
Thank you. One of slight corrections I would like to make to this chart would be to specify that equity as represented on the balance sheet of a bank does not equal to regulatory capital as defined by the Basel Committee, because the regulatory capital definition does not satisfy the balance sheet equation in terms of it is not equal to the result of assets minus liabilities, use equity. Some part of banks' liabilities, which are called subordinated long-term debt, counts towards regulatory capital. And the 8% minimum bank's capital adequacy ratio is the ratio essential of regulatory capital divided by risk-weighted assets. This number was decided on by the Basel Committee in 1988. One of the first, what is now called Basel I, and at the time it was called the Basel Capital Accord, was drafted and endorsed by the original members of the Basel Committee. These are the Western European countries, the United States, Canada, and Japan. Since then, it has not been changed even after the most severe of the crisis that the Basel Accords, I mean both the Basel I and Basel II, have withered since then in 1998. everything has been revised. The definition of capital, the rules of weighting assets by risk, but not the right-hand side of this inequation. Essentially, it's like a magical number of the Basel Committee. So everything you multiply by 8%, or to be correct, by its reciprocal, so 1 divided by 8 yields 12.5. You actually get the minimum capital requirement in absolute terms. In Russia joined Basel Committee in 209 after the financial crisis, when 13 more countries were invited to join this privileged club. But long before that, we started implementing in a piecewise fashion the Basel Accord. It was originally Basel I and Basel 1.5 that required market risk to be covered with capital. And originally, the level of capital, be it regulatory capital or accounting capital, has always been higher in this country than in other countries, especially before the financial crisis. And there were a number of reasons for this. One reason was the smaller share of assets, of low-risk assets that were attached risk weights below 100. I think I can show you a chart from my presentation that represents some of the history. No, not this one. It's, oh, wonder if you can see this. It's just for one country. I mean, on the left-hand side, you can see the evolution of the capital adequacy ratios of all the three imposed by Basel III. I mean, the CET1, Tier 1, and total capital adequacy ratio, which is now at about 12%. I mean, the total capital to total assets. If we calculate the average risk weight across the Russian banks by dividing the risk-weighted assets to total assets, we will arrive at a number close to 100%. So the most recent number I heard from today's meeting with investors was 105. If you compare it to European countries with an average risk weight between 30 and 40%, to North American countries with somewhat higher risk weights, but still not above 70 or 80% in the United States, for example, between 70 and 80, we still are significantly higher in terms of risk weighting. Why is it so? A few reasons. One of the reasons is that in the West, many large banks, maybe most of large banks, use internal models for calculating capital adequacy requirements, and they attach a risk weight which is derived from their internal assessment, internal models, and it can be well below 100% for the best segment of their portfolios. Another reason is that even banks that do not use internal models, for example, for credit risk capital calculations, they rely on external credit ratings. And if a borrower has a high credit rating, say of investment grade and higher, the risk weight will be below 100%. Russia has been the only country in the world that embarked on the so-called simplified standardized approach in 2010. And this approach imposes a uniform 100% risk weight for all corporate borrowers, irrespective of their credit quality. Essentially, we have been using regulation as a sort of a reinforcement for bank supervision. And our rules are relatively complex in terms of imposing higher than 100% risk weights to specific asset classes, for example, to consumer loans with high interest rates to mortgage lending with high LTV ratios to FX-denominated lending to corporate borrowers. And just it's a good time to mention that starting from today, Russia has become perhaps the first country in the world that has implemented to the fullest extent a separation of macro and microprudential regulation as far as capital adequacy is concerned. We have set all risk weights that previously could be well above 100% to their standard values from Basel II and Basel III, which is 100%. And all add-ons to these minimum Basel-specified risk weights will be imposed by the Bank of Russia using the same mechanism as for countercyclical capital buffer in Basel III. These are the decisions of the board of directors that are taken and announced well in advance before these add-ons are actually become mandatory. In other words, we have a fixed part of the risk weight that will not change over time unless the Basel Committee decides to revise them. And we have a variable part that can be altered by the decisions of the board of directors of the central bank. So this innovation comes into force today, and I congratulate us all with this significant step forward in separating these two branches of regulation, which has huge importance for us, both in terms of legal work and technical difficulties that we faced when changing risk weights every time this was required by the macroprudential reasoning, but also for allowing for more flexibility for the central bank and for the regulator to fine-tune the macroprudential toolkit and regulate, for example, the rates of growth on specific segments of the financial market.
So let's maybe do it step by step. Let me ask Martin, because there are many issues, many questions. Let me ask Martin about what should be the ideal regulation, capital regulation, and the fact that in Russia, essentially, we don't have any risk weight. So essentially, we have 100% weight on assets.
Well, I actually think very positively about not having risk weights. The book that Anna, Matti and I published a few years ago, we suggest that capital ratio should be between 20 and should be 20 to 30%. The idea being, if you're above 30%, you're completely free. Between 20 and 30%, you should not make distributions or pay bonuses, and below, you should recapitalize. I wouldn't swear by the numbers, but I would do so by the orders of magnitude. One issue about the numbers is accounting conventions matter, and if I take your balance sheet, what's a balance sheet? What about off-balance sheet items? What about the derivatives? I mean, in our view, everything should be on the balance sheet, but before one talks numbers, one really would have to talk about that. Now, concerning the risk weights, when I say that in say in Germany or in the West, the answer is the comment is immediately, but if you don't have anything for risk weights, they'll just go out and gamble. So my response then is, how about having two? Or how about having a constellation with risk weights, but only if that's more than the basis that you have without risk weights? The real problem is one of the dialectic and of hubris in dealing with risk weights. This dialectic the standard argument is, but surely a bank that incurs more risks must be required to fund with more equity. What that means, translated into the actual intentions, is, and I mean your discussion confirms that very much, is a bank that claims to be running fewer risks should be allowed to get away with less equity funding. Now, there are two dangers in that. One, risk is not something that we measure. 40 years ago, bankers knew that, and bankers would tell the economists, you economists are crazy. You use the same theoretical model. A client has a good event with probability P and a bad event with probability 1 minus P to talk about loans and to talk about insurance contracts. The insurer has a wonderful quantitative basis to assess what the P is. The banker assesses the P subjectively like that, turning his nose in the wind. Ever since capital regulation was attuned to quote-unquote measurements of P, bankers know that these things are measurable. But of course they are not. And the measurements are manipulable. There is empirical research showing that, you mentioned Basel II and the internal ratings-based approach, showing that for the same institution, loans that were provided under the internal ratings-based approach had lower credit risks, or lower default probabilities, and lower damage in default, losses in default, and in fact, a higher incidence of default, both in terms of frequency and in terms of losses, than loans that were provided under the standard approach. You wonder if these are objective measurements, how come you get this correlation? The other thing that's dangerous is that on some of these things, you get the risk weights down to 0. Now, what these risk weights are about is about the leverage, the amount of multiplication of funds that can be used by borrowing. So how much leverage can you get if you multiply by 1 over 0? That's the real problem. With many of the banks that had difficulties in the crisis, we were talking about leverage ratios above 50. Deutsche Bank had a capital ratio of 1.5, UBS 1.5 as well. That gives you leverage above 50.
Okay, it's an interesting observation. Let me ask you about this point that Alexei made about micro-prudential tools and macro-prudential tools. So should we use capital requirements to deal with macro issues?
I have no idea what that question means. Over the summer, we were traveling in Auvergne in France, lots of volcanoes. In the north, they have these wonderful cones, Stromboli type. In the south, they had stratovolcanoes. I wondered what that was, looked it up in the glossary, and these are volcanoes whose structure and history is too complex to be explained. So I was really amused by the ability of those people to use terminology to suggest that there was a meaning. I'm afraid with macroprudential, we're in the same thing. If you remember my discussion initially about those Thai banks and their funders, Lehman Brothers, they had stuff in warehousing that was unsaleable and got written down. The money market funds ran on Lehman when Lehman went bust, a money market fund broke the bucket was one upon, I told all that before. Given the freeze of the money markets, the European banks tried to sell assets. Within 3 weeks, global markets lost $20 trillion worth of value. That's between 3 and 4 times as much as they lost between 2000 and 2003 when the tech bubble burst. How do you put that into a macroprudential model for macroprudential regulation? The idea is wonderful. Now, if you look at the actual practice, if you look at the reasons given by the authorities for imposing such rules, they're very much ad hoc. Many of them are simply of the kind, such and such bank is systemic. We think the microprudential ratio is too low. We just want to add on to that. So it's used as a pretext. I think in terms of macroprudential, it would be much more important to have people observing what are these guys doing. Since to some extent this is an arbitrage business, which in equilibrium gives zero profits, they're always out to earn rents, earn profits in the form of risk premia, and risk premia are earned on macro risks. Now, they like to hide that both before the supervisors and before themselves. So the real question is, what are they doing? Where are they hiding them this time? And this changes all over. The allocation of sort of interest rate risk was quite different in the early 80s, quite different in the late 80s, quite different in the crisis, quite different now. Knowing about that is important as a way of beginning to think about what can we do about it. Other than that, when I gave a talk on exactly the things I've been talking about now, a bit lengthier and a bit with more evidence, afterwards one person came to me and said, how about just microprudential with a big equity requirement? The reason for the big equity requirement is that some of these asset sale processes would proceed much more slowly, meaning the systemic effects are much more contained.
Okay, thank you. Alexei, would you like to add anything or ask anything? No, the one who... Oh, let me ask then Alexei, who's further from me. So I know that Sberbank was the first bank in Russia that has implemented model-based approach to regulation. So I wonder how it goes, how many people are getting involved into this, how many NES graduates work in your department, and what do you think about this? And then we'll ask Martin about what he thinks about model-based regulations.
Yeah, so we were the first bank in Russia to introduce the internal rating-based approach for the capital calculations. And I think the importance, in general, I agree with everything that has been said here with regards to the risk weights and a wide range of the potential levers to change the risk weight. However, what I want to say is that the idea of the introduction of the IRB actually changes the bank in a way that it changes the corporate governance of the bank. You have a much stricter execution of some of the procedures. Plus, you get way much more exposed to the supervisor in a very different way. Having said that, I think there is a certain benefit from that perspective for the banks to introduce the internal rating-based approach. And I think actually that is the major benefit of the Basel II altogether, that it has changed the way the banks are governed and introduced a completely new view on how it should be done. When it comes to the macro-prudential supervision and supervision in general, I think what we should take into account is the systemic risk that we impose. This is to say that if a supervisor makes a wrong move, it can introduce a systemic risk into the balance sheet of the whole financial system, which can result in disasters. And I think partially the 2008 crisis has been a result of such an action, because when you think about the AAA rated securities, which were differently risk weighted just by the mere fact that they are AAA rated, any sane banker would be not in position to say no to such an asset on its balance sheet, especially when you take into the consideration that the banker is a hired employee with a limited time frame with the organization. That is pretty much it.
Okay, let me ask Martin. So I know that you don't like model-based regulation, but what are the most dangerous things if the world is moving towards model-based regulation? So what are the risks that are most difficult to quantify and capture?
So the risk?
The risks that are most difficult to capture in the model-based approach to regulation.
Well, many credit events are small frequency events. And the larger the client is, the smaller the frequency. If you think about the Eurozone, think about government risks, government bonds. I mean, I co-chaired an expert group on sovereign exposure. I think the only official body at the time that even bothered to look at that issue, zero risk weight for sovereigns. That seemed a bit nonsensical after the Greek default. How do you deal with that? Now, a major issue is sovereign defaults are extremely rare events, but if they happen, they're extremely large. How do you think about provisioning for that? What probability? How do you deal with probabilities? I don't think that at that level it makes sense to think about quantification at all. Which is why some of the participants in the expert group argued we should just forget about it. And I mean, the other feature that comes in there is that as long as things are good, all these guys have AAAs, which means that with risk weights, I mean, even with the risk weights that the Basel rules would stipulate, you don't get much. Applying Basel rules as they were as of 2014 would have meant 11 billion in additional equity for the 124 or 128 SSM supervised banks. That's peanuts. The thing that matters there is a large exposure regulation. That really would change things, but it would change things to such an extent that in some countries you wouldn't know who holds this stuff. So you then get into completely different issues of sort of how to engineer financial markets, financial institutions, and last but not least, the central bank.
There's a question.
Yes. So I actually gave a lecture today about the Asian financial crisis and the problem that often comes up in developing countries about, should I take the mic? Yes, and so my name is Doug Campbell. I'm a professor at NES. So I'd like to ask about the problem of foreign currency debt, which is often comes up in developing countries, most recently in Turkey. It was also an issue in Russia in 2014. I'm just curious what the Russian regulators and companies are doing about limiting foreign currency dollar-denominated debt, and whether this is, you think this is still an issue in Russia. Thank you.
Yes, it is an issue, and it has always been, because the Russian economy is plagued by a high share of FX-denominated settlement and essentially the amount of assets denominated in FX. What has recently been done is essentially what I said, using microprudential toolkit for achieving macroprudential purposes. We decided, I mean not we, but the Central Bank of Russia as a whole, as a regulator of both the macro activity and the micro risks of a bank, to curb FX-denominated lending to corporate borrowers by imposing high risk weights. They are not prohibitive. For example, if you compare them to risk weights we imposed a few years ago for residential mortgages denominated in foreign currencies, these newly imposed risk weights are not prohibitive. For example, if I remember correctly, the highest risk weight for loans denominated in FX to companies that do not have enough FX-denominated revenues is 130%, which is just by 1/3 higher than the standard risk weight. And this helped stabilize the growth rate. And essentially the policy that the central bank has proclaimed is called the so-called dollarization of the Russian economy. So in my view, this is my personal view as a bank regulator, it's driving out FX risk out of the banking sector to the corporate sector. This risk does not dissipate. It just goes from one book to another book. And it's now a headache of the corporate treasurers how to manage this risk rather than bank treasurers. What I'm concerned about, and this was my point when I mentioned this dilemma between micro and macroprudential regulation, is that originally risk weights were calibrated based on some objectively observed default statistics that can be verified by anyone that had access to these samples. And they were supposed to reflect some objective concept of risk. But, for example, macroprudential regulation does not operate with objective concept of risk. It operates with some expectations. For example, if we fear a bubble on a specific market segment, the bubble has never been observed and it has never burst. But we still have some fears. And we already impose high risk weights for assets that are traded in this market. This concept has nothing to do with objective actuarial measure of risk, something that is operated by insurers that have a long time series of risk events of losses, for example, and catastrophes. And this mixture of objective and subjective concepts of risk, and essentially their interference has an influence on portfolio choices of banks. Because if this risk scale is no longer objective, in part it's not the view of the bank what to do, but it's the view of the regulator what the bank should do or what should not. This is what I'm concerned about as a former student in financial economics, not as a regulator, because what I'm concerned about as a practitioner is the scarcity of the macroprudential toolkit. The goals are really worth achieving, and they're serious, but the toolkit is very limited. And this is my concern. Thank you.
Yes, please.
Should I have a mic? I'll bring it over.
My name is Andrei Zhuravlev. First, a little comment. It's, I think...
But try to be brief, because...
Of course, very brief, very brief. Just I'm going to say that it's a shame that there is a vacant chair and nobody from the smaller banks family, so to speak, who might have different views on the state of competition in this market and about the cleansing attempt, or, well, not attempts, cleansing activity by the central bank. They could have a quite interesting contribution to this discussion. A question that I have to the entire panel, I think, it's about so-called principle-based regulation. It's the thing that's more popular with the Anglo-Saxon jurisdictions. The Brits, the States, Australians, South Africa, which is not, of course, an Anglo-Saxon country, but still they subscribe to that. So what do you think about it as compared to the rules-based regulation that's is practiced in this country, and whether, given certain conditions, of course, whether the principle-based regulation may be a better choice for a healthier financial sector? Thank you.
Okay, thank you. I think it's a question for Martin, probably. Rule-based or principle-based?
Sorry, what?
Rule-based or principle-based regulation? What would you recommend?
I'm not sure I understand what principle-based actually means.
Should I try to explain, or it's going to be too long?
It will be probably too long.
I think you can understand it in a way that whether you like pillar 1 or pillar 2 more.
Oh, okay. I think pillar 1 is very useful in providing significant, well, in providing something like a rule of law. I think pillar 2 has been useful in the way it's been used in many cases, but I have been worried about deviations from the rule of law and the uncertainty that this would create for the industry. Let me give an example. In the 2011 recapitalization exercise, of stress test plus recapitalization exercise, there was a condition, if I remember correctly, to take sovereign exposures backdated to September 30th, which made sense as it was done, but I thought was inappropriate in a legal sense, namely that you impose a regulation ex post on something that's already passed, where the participants had no way of anticipating that that rule was going to be imposed. Another feature that I see is basically the supervisors have a bad conscience that Basel III did not really go far enough for many banks and have substituted by either pillar 2 or by other things. I mean, investigation of business models by supervisors, information requirements by supervisors. I mean, there are lots of interventions that have taken place that have substituted that they could easily do without if they just had higher equity requirements.
Okay, so high equity requirements. I would say that it's probably very difficult to design optimally all these capital requirements because of all these rules and many issues. So it's probably will have new crisis sometime soon anyway, at some point.
We would have that even with higher equity.
Yes. So I wonder, let me ask my last question today, because the time flies. First to the Russian side, maybe of the panel, how stable now how resilient is the Russian banking system. It had to go through many shocks recently, many sanctions, geopolitical shocks, lots of things. So how stable it is? Will we, in your opinion, be able to survive the next waves of shocks? Or what do you think the main problems of the Russian banking sector are? And then I'll ask Martin about more global picture on this question.
This is an interesting question. I think we're more ready and fit for a repetition of the previous crisis because we have higher capital adequacy ratio. We learned some lessons on how interest rate and liquidity risks should be managed. We have improved corporate governance. We have reduced some vulnerabilities inherent in the previous banking sector. But I'm not sure if the next crisis will be the same. And the truth is that the current system may be very vulnerable to new risks that may emerge over the course of the next few years. And the very nature of the regulation that always lags behind the market, the technology, and the trends and developments does not leave very much hope that we're 100% insured against the next financial crisis. So it can be triggered any time. The question is, what will be the net loss to the public funds? And I think some lessons have really been learned from the past financial crisis. And this cost, hopefully, will be less than it was 10 years ago. But again, this is a simple extrapolation of the events that happened in the past into the future, given all the conditions that we see, for example, on this chart, and the accumulated loan loss provisions capital, and other means of dealing with risk. So this is a question that goes beyond risk management, and the economics of bank regulation goes into the realm of economics of uncertainty. So it can be whatever.
I would agree to that. We have had several extremely challenging years, and those years were expensive, but still lessons which banking system went through, and I think also to the large extent a central bank went through, which adds up to the resilience of the banking system. However, there are still vulnerabilities, not only in the Russian banking system, I think in the global banking system, and I think the topic is always in the concentrations. So one should look for concentrations to actually spot the potential pain point.
But what are they?
So whatever they are. So it can be single source of income. It can be a large exposure lending to the large companies, which represent a significant share of the balance sheet. Lending in a single currency, whatever they are. So the concentrations in general.
Okay, Martin, what the next crisis will be? And what are the prospects of the European banking union?
Okay, European Banking Union, I think the single supervisory mechanism is doing as well, actually better than I expected. I never had any illusions about what it would bring, but supervision, I think, is on a good way. The problem is resolution is non-viable for the reasons that I sketched, which, in the case of institutions like Deutsche or BNP Paribas, would be unrealistic to expect anyway. I'm actually wondering whether the quote-unquote efficiency gains of global banks are worth the cost of not being able to resolve them. I think that's a serious issue that we will have to face at some point over the next decade. With middling-sized institutions, just a few $100 billion, we're also not able to resolve them for the reasons that I mentioned. In the case of Banco Popular Español, the only example where resolution has happened, it was basically an overnight fire sale to Santander, which worked because Santander was around. Otherwise, the run on Banco Popular Español would have created even more problems. Given the amount of non-performing loans on the books, in particular in Italy, but also in parts of German banks, that means we play Japan for another few years, which is a drag on everything, including a reinforcement of discontent with the euro system. Where is the next crisis going to come from? I'm worried about two things. The first, at the current very low rates of interest, going into yield for many institutions means going into maturities. And the savings banks, the local savings bank that provides a residential mortgage at something between 1% and 2% interest rate, fixing that interest rate for 15 years, may be in trouble 3 years from now, 4 years from now, if rates go up again. Maybe that's the reason why they won't go up again, but I don't find that too reassuring either. The other, an enormous amount of portfolio investment has gone into ETFs. And we have absolutely no idea about the liquidity of those markets, about the ability of the sponsors of those ETFs to maintain those markets, and about the potential fallout of runs on the underlying securities markets.
Okay. Thank you very much. I think it's the time to finish our first round table. Let's thank the speakers. Everybody knows in this room except Martin that in Russia we have these two questions: whom to blame and what to do. And we usually start discussing the first question, whom to blame, and we never move on to the second question. So I'm happy that today for 2 hours we have actually discussed the second question, what to do. I think it's much more important. So thank you very much to everybody. As a little gift, we decided we have a special gift for two gentlemen here. We decided to buy a book of Martin, and unfortunately we couldn't get the paper version, so we got electronic version for you, and please expect a link delivered to your email address tomorrow. Please take a look. It's a very cool book, very important for regulators and bankers. And then for Martin, because he doesn't need to read his book probably, we have 3 issues of the Russian journal Money and Finance. And it's the journal, it's the old Russian journal on economics that has been reformed significantly last year by the Russian Central Bank with the idea of promoting economics, promoting research about Russian economics by Russian professors, researchers, and just economic research in Russia. So we hope you'll enjoy looking at it. So thank you very much to everybody. It was the first event in the series of the events that we'll be organizing. We'll continue, this series because it's very important, I think, to discuss all these issues important for Russia and other countries also. So stay tuned, and you're very welcome to our future events. Thank you very much.